Let's jump right into this explainer. Today, we're putting on our equity research analyst hats to tear down Copart's Q2 2026 earnings. We're not here for the hyped-up headlines or standard revenue beats. No, we're going straight to the footnotes, the deferred metrics, and the actual data to figure out what's really going on under the hood of this absolute beast of a digital marketplace.
But real quick, before we get to the good stuff, here is our mandatory disclaimer. This is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
Okay, so we're kicking things off with a massive paradox, one the media is completely glossing over. Copart's Q2 2026 global insurance volumes just dropped by a pretty significant 9.3%. And if you look at the US specifically, units are down 10.7%. Now, normally, when a volume-driven platform sees a double-digit drop in inventory, the narrative turns incredibly bearish. Yet management is aggressively buying back hundreds of millions, actually scaling to billions in stock right into the teeth of this decline. So how can both of these things be true at once?
Let's hit Section 1 Earnings Reality Check.
If you're just looking at the surface-level numbers, well, it looks pretty grim. We're talking across-the-board declines. Consolidated revenue fell 3.6% year-over-year to $1.12 billion. Net income down 9.5% to $350.7 million. And like we just mentioned, global insurance units dropped 9.3%. Look, if you're a headline-skimming algorithmic trader, you probably hit sell right there. But as analysts, we have to dig deeper into what's actually skewing these year-over-year comps.
To be completely objective here, we have to talk about CAT units. That stands for catastrophic units. These are vehicles that come from large-scale isolated loss events. Think massive hurricanes. Last year's Q2 numbers included over 49,000 of these CAT-related vehicles, heavily driven by massive storm activity. When you're analyzing a business like this, you literally have to separate those unpredictable acts of nature from the core operational run rate.
Because context is everything. When you strip away those catastrophic anomalies, it reveals a totally different reality. Without those CAT units from last year skewing our baseline, consolidated revenue actually rose 1.3%. Now, okay, 1.3% growth isn't exactly a blistering pace, right? But it is fundamentally different from a 3.6% contraction. The core business is actually holding the line, despite some serious macroeconomic headwinds.
Moving on to Section 2, the fee machine.
What's fascinating about Copart is how they make money regardless of the actual quality of the metal being sold. Let's look at a real-world example from a recent fee calculator update. Say a buyer wins a low-value salvage vehicle with a $350 live bid. Well, they aren't just paying $350. The total cost to that buyer balloons to $675 because of a heavily layered fee structure. Copart is generating a massive yield on even the lowest value transactions on their platform. Just look at this granular fee breakdown. Out of that extra $325 in auction fees, you've got a $145 buyer fee based on the bid bracket. Then you stack on a flat $95 gate fee, literally just for the administrative cost of the vehicle leaving the lot. Then add a $50 virtual bidding fee for using the digital platform. Finally, a $20 title handling fee and a $15 environmental fee round the whole thing out. Guys, these aren't just arbitrary numbers. This represents a high-margin, low-friction remarketing model that milks every single stage of the transaction. This is exactly how they maintain those robust margins, even when unit volumes take a hit.
Let's dive into Section 3, red and green flags. We're starting with the bearish case. 7 deep red flags that the media blackout totally missed. First, U.S. insurance units dropped 10.7%, which is a glaring issue ignored because it ruins the whole growth narrative. Second, a consumer pullback in auto insurance coverage is directly suppressing claims, a macroeconomic nuance that's just too complex for a quick soundbite. Third, there's a hidden $6.8 million international VAT expense hitting gross profit buried deep in the footnotes. Fourth, global operating income fell 8.8%, showing some real margin pressure the street mostly missed. Fifth, blue car commercial consignment is down 11.8% as rental companies decide to repair instead of replace, and standard models just aren't capturing that shift. Sixth, U.S. inventory balances dropped 8.1%, which means a thinner pipeline ahead that backward-looking metrics won't catch. And seventh, strict rules, like $50 late payment fees, are adding immense friction for downstream buyers, a reality that automated algorithms completely miss.
Now, before we look at the positives, we need to objectively understand total loss frequency. This is the secular tailwind holding Copart's entire foundation together. Basically, it measures the percentage of accident-involved vehicles that insurers decide are completely totaled, rather than worth paying to repair. Because when a car is totaled, it heads straight to a salvage auction like Copart.
All right, let's talk about the 7 overlooked green flags hidden beneath those headline revenue misses. First off, free cash flow increased an incredible 58%, something the media often ignores when they're solely focused on top-line growth. Second, AI is turbocharging their engineering productivity, a detail tucked way deep in management commentary. Third, their Title Express platform dominates cycle times, getting cars sold up to 10 days faster, which qualitative analysts often ignore. Fourth, total loss frequency just hit 23.1%, up from 15.6% a decade ago, a secular trend that's too slow for the daily news cycle. Fifth, international average selling prices shot up 9%. Sixth, they now own land across over 250 global facilities, creating a physical moat that Wall Street really struggles to properly value. And finally, seventh, a $13.4 million favorable foreign exchange impact boosted international revenue, a bright spot completely masked by the headline misses.
Section 4. Moat and Market Dynamics.
The absolutely crucial point is right here, articulated by co-CEO Jeffrey Lau. He said, liquidity begets liquidity. Copart's true structural advantage is the network effect of having a massive global buyer base ready to bid on absolutely anything. An insurer in the Midwest knows a severely damaged pickup truck might be perfectly priced for a buyer in Central America. That global matchmaking, that's what creates the moat.
And the ultimate metric of that liquidity is the average selling price, or ASP. If Copart's marketplace is truly the most liquid, they'll command the highest prices for their sellers, and the data proves this out. U.S. insurance ASPs materially outpace the broader industry, rising 6% on a reported basis, and an impressive 9% when you exclude those lower-value CAT units.
Let's look at how this builds into an unstoppable flywheel. It starts with Step 1, accurate data, AI routing, and high-quality images. Step 2, that transparency gives international bidders the confidence to step up and engage aggressively. Step 3, that fierce bidding war drives up the ASPs. And finally, Step 4, those higher returns are handed back to the insurance carriers, which ultimately convinces those insurers to hand Copart even more of their total loss inventory, market share, and trust. It's a perfect loop.
Section 5. Capital Allocation Verdict.
Look, Copart boasts an absolute fortress of a balance sheet. They ended the quarter with roughly $5.1 billion in cash and cash equivalents, and get this, 0 outstanding debt. 0. If you run a Ben Graham reality check here, yeah, the PE is elevated, but this cash hoard acts as a massive margin of safety. Similarly, if you apply a Warren Buffett owner's earnings analysis, it reveals exactly the kind of moat, a return on invested capital consistently above 15% and a zero debt profile that he looks for. In an era where companies are getting choked out by rising interest rates, Copart has impenetrable flexibility.
And they are actively using that flexibility. Management is confidently leveraging that cash to aggressively repurchase stock. In the first half of the fiscal year alone, they repurchased over 13 million shares for more than $500 million, and they're accelerating that pace to $1.63 billion for the full fiscal year. Buying back stock heavily, right into the teeth of declining U.S. claims volumes, that tells you exactly what management thinks about their long-term intrinsic value versus current market prices.
Bringing it all together for our final verdict. After running Copart through our 21 model valuation gauntlet, spanning discounted cash flow, unlevered free cash flow, dividend discount models, real options valuation, and comprehensive multiple analysis, the stock appears fundamentally fairly valued to slightly overvalued at current prices, essentially pricing in much of this operational perfection. However, their economic moat is undeniably expanding across Morningstar's metrics. They exhibit massive network effects, intangible assets through proprietary AI routing, and immense efficient scale by leveraging their balance sheet to buy up scarce physical land. They are aggressively consolidating ownership for long-term shareholders.
So, I'll leave you with this provocative thought. On one hand, near-term volume drops and a tapped-out consumer suggest a storm is brewing. But on the other hand, the secular rise of total loss frequency and a bulletproof zero-debt balance sheet make Copart look like an unstoppable force. The headline models are pointing one way, but those hidden flags suggest a storm. Which side are you on? Do your own homework, and we'll see you on the next explainer.